Hello, I'm Bob Hartwig, and I'm a professor of finance, risk management, and insurance at the University of South Carolina. It's my pleasure to be here with you and to help you understand a bit more about what the impacts have been with respect to recent events in the property liability insurance industry, and particularly what those impacts are going to be in terms of 2018 renewal business. There are a lot of factors here, but I think everybody knows that 2017 was a year for the record books. After a relatively quiet period, 2017 on a global scale shattered records or came very close to records in terms of catastrophe losses. Not just terms of hurricanes, but wildfires and also flooding events all around the planet. But in addition, we have other pressures, some of which you may not have paid that much attention to in the sense that they were really in the background. And one of these would be low interest rates. Low interest rates are not something new. They've been around ever since the financial crisis. And the reality is that the insurance industry is still trying to adjust to this low interest rate environment that we have today. And even though rates have come up a bit, they're still far, far below their pre-crisis levels, generating additional rate pressure. And in addition, we also have some claim frequency and severity issues in key lines, such as commercial auto, and of course in some areas, such as property, where we've seen the headline catastrophes, not just hurricanes, but such things as wildfires as well. So what to expect in terms of 2018 renewals will, as always, depend on your individual exposures and your individual experience. And loss-affected accounts in particular are likely to see the largest increases, perhaps somewhere in the 5 to as much as 15% range. Non-loss affected accounts somewhat less, again depending on location and a variety of other factors. But certain other coverages such as commercial auto, D&O, and cyber, for some very obvious reasons such as an outbreak in securities lawsuits, an outbreak in terms of rapid increase in the frequency of vehicle claims on the highways and byways of America, and of course the very high profile cyber breaches we've seen all across the world in 2017 are creating pressures in other lines as well. So let me take a little bit of a deeper dive into this. What is driving the prediction for a bit of a firming in the commercial insurance markets in 2018? Well, again, we already mentioned the record or near record catastrophe losses. This was all over the headlines for the entirety of the past year, and quite frankly, these events are likely to continue into 2018. There's no reason to believe that they will not. 2017 was one of the 3 costliest years in global history for insurers. We've had very large underwriting losses generated by these record catastrophes, combined with years of underpriced business in other key lines, such as commercial auto. Rising reinsurance prices. This is one pressure that all insurers are seeing today around the world. Reinsurers were hit hard, as were retrocessional arrangements, that is, reinsurance for reinsurers, whereby the risks of the catastrophes of the past year were spread around the world. But the bottom line is this generating a lot of pressures for insurers around the globe today. The low interest rate environment, again, although the Federal Reserve has edged rates up ever so slowly, the reality of it is that a full normalization of interest rates in the United States is not likely until the early or mid-2020s. Now, this has brought the ROEs of the insurance industry under tremendous pressure. Sharply higher underwriting losses, chronic underpricing in key lines, depressed investment earnings have all conspired to drag the ROEs of the industry down to 15-year lows. In other words, post-9/11 lows. And of course, you can't get away from the fact that geopolitical risk is rising everywhere. Again, it is a headline issue, but it means the world is risky. We in the insurance industry, in the reinsurance world, know it's risky, and that too can generate uncertainty that can pressure rates further upward in certain key lines. Let me just summarize for a moment. Pressure on rate is mounting. It's coming from a variety of quarters. We all know that 2017 was a record or a near record year for catastrophes, not just in the U.S., but on a global scale. And that rates, of course, will need to adjust to reflect pressure on both the primary commercial and reinsurance markets. Persistently low interest rates, a very important but unappreciated factor in terms of pressuring commercial lines rates, again, particularly the long tail lines, such as workers' compensation. And the rising claim frequency and severities in lines such as commercial auto as the highways and byways of America become more and more crowded. What we also see is that this pricing reaction, if we look in history, many times we can see that it's a normal part of the property casualty insurance underwriting cycle. 2018 renewals could be in the mid to upper single digits and somewhat more for loss-affected accounts. But the good news is that the industry remains strong, stable, sound, secure, with many opportunities ahead. But to realize these opportunities, this will require a commitment of significant additional insurer capital. And the industry needs to remain strong throughout this period, and I have every belief that it will. Thank you very much for your time and your attention. It's been my pleasure to speak to you today.